Tired of watching your paycheck disappear? Dream of turning your savings into something more? Then buckle up, because today we're cracking the code on building wealth with Robert Kiyosaki, the mastermind behind Rich Dad, Poor Dad. Imagine you have $10,000 tucked away. It's tempting to spend it on that dream vacation or the latest gadget, but what if we told you there's a way to turn that $10,000 into a powerful tool for building long-term wealth? Intrigued? Let's leverage Robert Kiyosaki's wisdom with 5 of his most actionable tips to help you become an investor, even with a smaller starting amount. Tip 1. Building a strong foundation. Knowledge is power. Before we jump into specific investment strategies, let's solidify the ground beneath your feet. Kiyosaki emphasizes that successful investing starts with education. Unlike other areas of life, you can't win the investment game without understanding the rules. The financial world can be complex, filled with jargon and hidden risks. But fear not. Here's the good news. You don't need a fancy Ivy League degree or expensive seminars to become financially literate. Here are 3 simple ways to build your financial knowledge base. First, borrow from the library. Public libraries are treasure troves of information. Start with classics like Kiyosaki's Rich Dad, Poor Dad, or explore broader personal finance titles. Look for books that resonate with your learning style, whether it's text-heavy or filled with visuals. Second, explore free online resources. The internet is a wealth of information, and personal finance is no exception. Reputable websites and YouTube channels offer a wealth of information on various investment topics. Look for resources from established financial institutions, accredited advisors, or independent creators with a proven track record. Third, consider online courses. While not always free, some online courses can provide more structured learning on specific investment strategies. Platforms like Coursera or Udemy offer courses at various price points and difficulty levels. Choose a course that aligns with your interests and learning goals. The key is to actively seek knowledge in these 3 ways to build your financial knowledge. The more you understand about different asset classes, like stocks, bonds, and real estate, investing strategies like value investing or growth investing, and the core principles of wealth creation, the better equipped you'll be to make informed decisions with your hard-earned cash. Okay, you've built your knowledge base. Now let's talk about a crucial mind shift. Most of us are conditioned to the employee mindset. We trade our time for money with a job. We work hard, get paid, and that cycle continues. Kiyosaki proposes a different approach, the investor mindset. Tip 2. Shifting your mindset from employee to investor. The investor mindset is all about putting your money to work for you, generating passive income that flows in even when you're not actively working. But before you dive in, it's important to have a clear target in mind. What are your financial goals? Do you dream of traveling the world for a year, buying a house, or retiring early? Having a specific goal will fuel your motivation to become an investor and guide your investment choices. For example, if your goal is early retirement, you might prioritize investments with long-term growth potential. If your goal is buying a house, you might focus on saving a down payment and consider investments with lower risk profiles. If your goal is traveling the world for a year, you might prioritize saving a specific amount within a shorter time frame and look for investments with a balance of growth and easy access to funds. So, you've armed ourselves with knowledge and a clear vision. Now let's get down to business. Tip 3. Taking action. Small wins equals big wins. Many people believe they need a huge sum of money to invest. Kiyosaki disagrees. Here's why starting small and investing consistently can be incredibly powerful. The concept is based on compound interest, often called the 8th wonder of the world by Albert Einstein. Imagine your money earning money, and then that money earning even more money, like a snowball rolling downhill. However, before tasting the magic of compound interest, you need some extra cash to invest. Here are 2 ways to find some extra cash to jumpstart your investment journey. First, review your budget. Can you cut back on small expenses like daily coffees or impulse purchases? Every saved dollar can be used to invest. Look for areas where you can streamline your spending without sacrificing your quality of life. Second, explore side hustles. Do you have a hidden talent or skill you could monetize? Freelance your writing skills, create an online course, or take on odd jobs in your free time. There are many ways to bring in extra income through side hustles. After you have some extra cash to invest, you just need to take action and develop the habit of regular investing. Even a small amount invested consistently over time can snowball into significant wealth. Remember, it's not about how much you start with, it's about starting and building a consistent investing habit. Now that you've got the knowledge, the vision, and a plan to put your money to work, let's talk about making smart choices. Tip 4. Making smart choices. Don't fear risk, manage it. There's a difference between taking a calculated risk and gambling all your money on a whim. Kiyosaki warns against those get-rich-quick schemes that promise high returns with little effort. These are often risky and can lead to big financial losses. Before investing in anything, research different options and evaluate their risk-reward profile. Here are 3 general investment categories to consider. First, lower risk. These investments offer lower potential returns but also come with less risk. Examples include government bonds, certificates of deposit, and high-yield savings accounts. These can be good options for your emergency fund or for short-term savings goals. Second, moderate risk. These investments offer a balance between risk and reward. Examples include dividend-paying stocks, mutual funds that invest in a mix of assets, and real estate investment trusts. These can be suitable for long-term investment goals. Third, higher risk. These investments offer the potential for higher returns, but also come with greater risk. Examples include individual stocks, options, trading, and venture capital funds. These are generally suitable for investors with a higher tolerance for risk and a longer investment horizon. Even if your investment is lower risk category, after checking your investment risk, diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes to mitigate risk. I have made a separate video on it with complete details. You can check that out. Now that you've embraced smart risk management, let's talk about the importance of patience. Tip 5. Patience is key. Stay invested for the long haul. Building wealth takes time and discipline. Don't get discouraged if you don't see results overnight. The stock market can be volatile, with periods of ups and downs. Kiyosaki emphasizes the importance of staying invested for the long term, allowing compound interest to work its magic. Create an investment plan that aligns with your risk tolerance and financial goals. Regularly review your portfolio and rebalance as needed to maintain your desired asset allocation. Don't let emotions dictate your investment decisions. Stick to your plan and avoid making impulsive trades based on market fluctuations. You are now equipped with the foundational knowledge to begin your investment journey. Embrace continuous learning, stay focused on your goals, and make smart, calculated choices. With time and discipline, you can turn your $10,000 into a powerful tool for building long-term wealth and achieving financial freedom. Here's a bonus tip for you. Consider seeking professional guidance from a licensed financial advisor. They can help you create a personalized investment plan based on your specific circumstances and goals. Conclusion. There you have it. Robert Kiyosaki's 5 actionable tips to jumpstart your investment journey, even with a smaller starting amount. Remember, building wealth takes time and discipline. Don't get discouraged if you don't see results overnight. The stock market can be volatile, but by staying invested for the long haul and consistently putting your money on a regular basis like weekly or monthly or yearly, you can harness the power of compound interest and turn your $10,000 into a powerful wealth-building machine. This is just the beginning of your financial education adventure. Keep learning, stay focused on your goals, and make smart, calculated choices. So, what are you waiting for? Take control of your financial future and start building your wealth today. Thanks for joining me today. If you enjoyed this video, be sure to like and subscribe for more. Happy investing!